US stocks saw a mixed performance across the week, with the Dow Jones showing resilience whilst tech stocks sold off sharply. Concerns surrounding the AI trade, its impact on software companies, but also huge capital expenditure for AI build-out has unnerved the market. Elsewhere, the US dollar has risen to a two-week high on likely safe haven flows, while safe havens gold and silver have behaved more like risk assets. But what about the coming week? To talk us through what he will be watching, I'm joined by Global Head of Content, John Kicklighter. John, great to have you.
Thanks for having me.
So risk sentiment has taken a hit. Do you see this following through to next week? What are the market conditions you're expecting next week, and which markets will you be watching?
So if we look back over the past 3 or so weeks, we were talking about the gradual or slow pickup in volatility and seeing a little bit of it expanding just beyond the most sensitive of the risk-based assets. So I think we are making traction towards a more generalized, a broader, a more intense risk aversion. And I think that's really where we need to be looking. How far will it go, or how committed will the market become remains to be seen. There is a very significant effort to prevent it from really cascading, which I'm not surprised. People have a lot of exposure, and it's not going to be too easy to get out, especially as you've gotten in at the latter ends of these advanced moves. It's going to be turning into red very, very soon. So making all these efforts to try to hold back is going to be certainly something to keep tabs on. Now, you have markets like Bitcoin, which was a big story over the past week with this 3-week tumble. And it is a much more sensitive risk asset. It's, I think we're starting to see that it's much more speculative in nature, not necessarily the core slow and humdrum kind of component of the financial system that it's often spoken to be by many, but it's more that exposed risk asset that everyone wants to get in, buy low, sell high kind of mentality. And that's not seeing as much exposure. It's not seeing as much participation. And when you have that pullback, there's not that market set in to stop it from or arrest its decline. Not like a S&P 500, certainly not like global equities and other risk-based assets. So going forward, I think we just really need to see how far is that traction going? How much is sentiment leading the way? Not necessarily looking for headlines or event risk to trigger a particular discrete move, but rather is sentiment more broadly committed, whether that be a rebound, which is also possible, but really the traction and the momentum would come if it cascades into more of a risk off and a broadly risk off consideration. So in terms of like the market approach that I would take, I'm more interested in breakouts because we still have a lot of congestion from the likes of the Dow or even the NASDAQ after it took out some of its support, or emerging market assets and the like, and maybe tentative trends, but really weigh your convictions. If you are very risk averse, set your convictions higher. Don't commit to a trend unless you really see it kick in, whether it be technical or fundamental or both. And I would also stay away from really dip buying, really sticking to ranges with discrete levels, because this kind of volatility as it rises, it's going to make it more difficult to hold up to those levels, especially if you don't place reasonable stops in volatility. And markets to watch, I would be watching really the measures of spread. So NASDAQ to Dow, for example, NASDAQ took out some meaningful support over this past week, but the Dow, at the time of this recording, is actually near the top end of its range and just off historical highs. So looking at that ratio, looking at the S&P 500 versus the VEU, which is a rest of world ETF, you choose your preferred representative of global equities, but seeing if the slide in the S&P 500 spreads to the DAX, the FTSE, the Nikkei 225, or what have you. Bitcoin is definitely the hot wire for risk trends. Keeping tabs on that can be very indicative about how the trend is oriented, but also how intense it could potentially get. I'll also watch gold and silver. Obviously, to your point, they're not really acting as the safe haven as they used to. So is this going to continue to upend the relationship? And of course, dollar and maybe U.S. interest rates, because we're going to get back into a consideration of monetary policy and the US dollar as the Sell America trade, which I think has kind of dropped off a little bit on that theme.
And then, yeah, touching on themes, what are the themes that are in focus for you next week?
Well, I would very much keep the focus on risk. Look for the hallmarks, the benchmarks, the guiding lights of sentiment. If it is a spread, is really what I'm interested in. Because once you see that committed risk on or risk off, and it's universal, even if it's a moderate tempo, if it's universal, you will see that it significantly distorts the reaction of events or headlines or what have you. So if you're significantly risk on, good news will be really brought in and put into price action, whereas bad news is generally overlooked, and vice versa. This, I think, confuses a lot of traders because they can't understand why event risk doesn't always have exactly the same amount of impact on a market, dependent upon how the surprise comes out. And it's because of that. It's that backdrop condition that you have to first be aware of. But you also need to be mindful of Trump headlines, so Trump-related headlines. Obviously, there's conversations going on in Iran, between the United States and Iran, or in Oman, talking about nuclear talks. That's uncertainty. We still have tariffs hanging over the market's heads. We still have lingering conversations of the U.S. and potentially returning to a shutdown again in the future. These kind of headlines can come out of nowhere, and even new ones come up. And depending on the market's sensitivity to it and where it is in the risk spectrum, it can certainly trigger some more significant movement. Now, in terms of the traditional macro themes, we don't necessarily have a lot on the docket this coming week. So I'll probably disproportionately look towards monetary policy, maybe a little bit of concentration on economic growth. But there really isn't that big, dense docket that is going to distract us. It can be as much a anticipation that curves market movement as it is a major update that moves the markets. I think we're really going to be swimming in sentiment as a undercourse.
Yeah, so I mean, just touching then on event risk. I mean, obviously the US non-farm payroll was delayed from this week to next week, but that's till next Friday. So there's quite a lot to get through, I guess, between now and next Friday. What will you be watching for your top event risk?
Sure. So Monday, I think I'll be watching to see what the headlines are and how markets are reacting to them, because we have the Japanese snap election, although there's a heavy expectation there. There's the political uncertainty in the UK with Stammer and whether he's going to remain or not. That seems to be upending a lot of, or at least adding some volatility to a lot of UK-based markets. So I want to see how that comes out into the weekend, into Monday trade. But if you're looking for event risk, I mean, there's really not a lot. I would say the U.S. CPI expectations from the New York Fed. On Tuesday, we get a little bit more active, and it's very U.S.-centric this week. U.S. NFIB, which is the business conditions or business confidence figure, U.S. retail sales. You want to see how the consumer is doing. They're the driving engine of the U.S. economy. And earnings, we have BP, Coca-Cola, AstraZeneca, Ford. Those are all worthwhile for different themes, not systemically important necessarily, but they can tap into deeper currents potentially. Wednesday, I would watch for China inflation. We have the U.S. budget statement for January. Obviously, U.S. finances is a growing and consistent drumbeat in the background. And actually, non-farm payrolls is on that Wednesday. So that's going to be that carryover we want to see on that one part of the dual mandate, which we will get rounded out by the end of the week. Thursday, we have UK GDP, which is not just the monthly, it's also the fourth quarter, worth watching. And earnings after hours, we have Applied Materials, so getting a little bit of that additional tech interest, but we'll see if it really taps into the AI and the AI investment considerations that we saw with the Mag 7. And Friday, Chinese housing prices. Can't forget China has a significant number of issues that it's carrying forward. And then, of course, we have U.S. CPI. Which of those two figures, non-farm payrolls or CPI, inflation or labor conditions, will commit the next move from the Fed, and that timing of that next move? We have a very moderate probability of a March rate cut. And if it's going to rise or collapse really depends on those two indicators.
Well, thank you very much for your insights once again, John. Great to have you.
Thank you.
For more videos like this, please do like and subscribe.